Stagflation talk has picked up across Wall Street as inflation runs red hot and interest rates creep higher. But is this talk even warranted in light of the March jobs numbers? PNC Asset Management Group Chief Investment Officer Amanda Agati joins us now. Amanda, always good to see you. All week, I've had people telling me that we might be in a stagflationary environment. Do you think we are? And does this jobs report even support a view like that?
Well, it's great to see you. Thanks, as always, for having me. No, resounding no in terms of being in a stagflationary environment. And I would just say that today's jobs report is definitely confirmation of that. We view it as a strong to quite strong report, to give you a Ben Stiller Meet the Parents reference. You just have to admit that the labor market is very strong here and very healthy. Yes, there's still room for recovery from here, but certainly very tight. And so in a stagflationary environment, we usually see a much weaker labor market and jobs backdrop than what we're seeing today. So yes, we are in a slowing expansion phase of the cycle. We have to be honest about that. The rate of change is certainly slowing, but with such a strong jobs report and a tight labor market, I don't think we can say that it's stagflationary anytime soon here, and certainly not as of today.
Hi, Amanda. It's Julie. So that said, when we are looking at the inflation readings that we've been seeing, where are you seeing that pinch in this economy?
Well, it's hard to argue that anybody is getting by unscathed. I mean, we're definitely seeing broad-based price increases across the board. And so, this is definitely a sustained inflationary environment. We had hoped at the beginning of the year that we were going to start to see by now more supply chain normalization to help take some of the inflationary fire out of the backdrop. Obviously, that is not materializing at all. And so we're certainly feeling the effects of that pretty much across the board. I think what will be more telling is not necessarily where we're seeing the pinch or the pain in particular, but what happens with Q1 earnings season. We're sitting at profitability levels that are basically at cycle, if not record highs. And so the key will be, will companies have been able to pass through or continue to pass through price increases and maintain this profitability backdrop, or are we going to start to see that pinch come into effect in earnings season? And so I do think Q1 earnings season will be very telling from a signaling perspective around the impact on inflation at this point in the cycle.
Well, this week we have gotten some negative signals on that. Restoration Hardware and Tempur Sealy as well, warning about current demand trends and inflation. But to your point, Amanda, what companies this earnings season might surprise investors to the positive? I'll be positive for once. What companies are pushing through those price increases and they might have good quarters?
Well, we continue to lean growthy in terms of our positioning and portfolios and our recommendations to investors. We continue to believe that the growth side of the equation in a slowing growth backdrop will be very well positioned, even though we've seen growth take it on the chin pretty significantly here in the first quarter. We're using it as an opportunity to rebalance and add exposure there, but not necessarily backing up the truck around aggressive growth. We're really looking at quality growth at a reasonable price. We think those exposures, those companies are very well positioned. The fundamental backdrop continues to be very, very strong there. And so we think from an asset light, capital light balance sheet perspective, they are very well positioned to not see as significant of a headwind from some of this inflationary fire as some of the other parts of the market. So it may be a little bit of a contrarian view, but we think growth is still the place to be at this point in the cycle.
Yeah, Amanda, that is really interesting because definitely we are hearing a lot of value folks come out here and say now is the time finally for value. But one of the stocks that you like right now that's in the category of what you call growth at a reasonable price is Microsoft, which is a pretty popular one right now. We've had a lot of positive chatter around the stock lately. What is it for you that puts you in the Microsoft camp right now?
Well, I wouldn't say that there's anything specific about Microsoft other than it's the poster child for what we believe is a really strong fundamental backdrop. It checks the boxes from a high quality, a growth at a reasonable price perspective in terms of exposure here. Definitely been able to pull away from the pack over the course of the pandemic, using the pandemic to a degree to drive fundamental strength. And so it really sets them apart. And in a more challenging backdrop that we find ourselves in with, these macro headwinds building, we think that the power of their business model, the strength and quality of their balance sheet will continue to serve them well. And so we continue to believe that they're a very good example of how well positioned GARP is in this environment.
Well, Julie took my question, Amanda. I was excited to ask you about Microsoft, so I will switch gears in real time. J&J, give us the pitch.
Oh, well, I don't know that I can give you the underlying pitch there, but I think it's a similar story. But when we think about J&J, it's really the poster child for large cap dividend growth. So for as much as I'm saying, we really think that growth and growth at a reasonable price is positioned well in this environment, we also like large cap dividend growers. In a sustained inflationary environment, you really want exposures that can outpace this elevated inflationary backdrop. And so we think it's a great example of large cap dividend growth being well positioned. They haven't certainly taken it on the chin as hard as other exposures, so not necessarily the table pounding buy that some other aspects of growth are, but we actually think that this is a very well positioned type of exposure that has legs more than just a quarter or so in this cycle. We think large cap dividend growth is the place to be for the next year or two at least, given the backdrop that we're in.
Hey, that was a great pitch. I will indeed take it. We'll leave it there. PNC Asset Management Group Chief Investment Officer Amanda Agati. Have a great weekend. I'll catch you on Twitter.